All right, so I think I'm live. I didn't hear my prompt. But anyway, this is Q1 2022 for Medical Properties Trust is their earnings call summary. And I know that this slide cannot be seen very well. I can't blow it up. I apologize. But I wanted to discuss what was the overarching story in the call this quarter. There was no talk of company profit. There was no talk of anything other than basically one small financial key ratio. Um, I have to say right away that they did beat expectations on profit, which is really good, but they did miss expectations on revenue. A lot of that has to do with the fact that they just sold a portion of their hospitals to a joint venture. And that's kind of what I'm going to go through here on this slide. Um, the CEO talked a lot about the rumors that have been surrounding this particular company for quite some time, and you can sort of tell just in the wording of the transcript that he was in his feelings about it for sure. Uh, there has always been conversations surrounding their operating partner, Steward, and I'm saying partner, but that's kind of the issue, right? So Steward is a hospital operator, meaning that they're the management for the hospital. They hire the doctors, they hire the nurses, they handle all of the operations, all of the repairs, all of the equipment, everything that's needed to run a hospital. Steward is the company that does that. The building, however, is owned by Medical Properties Trust and then leased out to Steward. And so for a very long time, Steward has worked hand in hand with Medical Properties Trust to make sure that the hospital, is profitable for you know for the best term here. Um, it has been said that Steward is not the best company, and that Medical Properties Trust is really in business to help Steward survive. And so Medical Properties Trust has done their very best to distance themselves from Steward. Steward is still very much a part of the goings on in Medical Properties Trust, but they have been less so. Okay, less so. And so they've been slowly but surely getting out of Steward hospitals and getting into some other hospitals with some different operators. They've also expanded overseas, of course, Australia, Europe, and South America. So um, that being said, I do want to kind of go through these numbers really quick. At the very top, you see this is investment as of March 31, 2022. Keep in mind these numbers are in thousands. Okay, so you got to add three zeros to the end of this to get the actual number. So we're looking at this first number of 363 million. Okay, and so that is by far the largest investment that Medical Properties Trust has made, and that goes to Steward. If you come down the list here, there's another Steward there at 139 million. So all in all, about $500 million is tied up with Steward, and these are just the investments that Medical Properties Trust are involved in. This does not concern the straight up hospitals that they currently own and are leasing out. So there may be some other hospitals in there that Steward is operating in that Medical Properties Trust owns. But like I said, these are just what are considered their investments. Okay, and so let's go through just a couple of these just to kind of explain what Medical Properties Trust does and why they are in some of the trouble that they're in. Also, I didn't say this at the beginning, and I apologize. Again, they did beat expectations on profit. They missed expectations on revenue, and the stock price has come down really hard. The stock price was up to about $22, $23 months ago. Now it's down to the $17, $18 range. So, real estate, as we've said before, has not been the best sector to be in, and that is so true right now. Looking at what is happening with Medical Properties Trust and their stock price, but I still do think it's a good company. I'm going to do a valuation for the company today, so I'll be able to really dig into the numbers and see what's going on before we look at purchasing more shares. Really great dividend. So if we do purchase more shares, we'll be getting an even higher dividend than what we have right now, which is hovering at about, I think, 5%. So you're really looking forward to getting into that and seeing what's going on. Okay, so let's look at this. So number one, like I said, the first investment you see here, it says that a loan is secured by the equity of Steward and provides for an initial 4% cash return along with possible outsized return based on the increase in value of Steward. And so that's why this is listed as an investment, okay? Because Medical Properties Trust stands to gain money on the increased value of Steward as a company, meaning that obviously there is some sort of stock or something like that involved with this particular investment. And so the loan means that this is a loan that Medical Properties Trust will have made to Steward, and Steward is using the stock, the equity of the company, right, the stocks, to secure that loan, meaning that if Steward doesn't pay the loan back, the Medical Properties Trust will then own Steward stock. And so that's not necessarily a great thing, because if Steward cannot pay the loan back, the stock is not going to be worth a whole lot, because by that time, I'm pretty sure we'll start to see the stock price come way down, right, if they're running into money troubles. So that is sort of an issue. I've never looked at the Steward stock, so I think I will do that when I do a valuation for Medical Properties Trust, because I think even though they have done a great job with again, distancing themselves from Steward, they are still something like, maybe I want to say 20% involved, or at least. So we'll kind of look at that. So let's look at a couple more. Well, I'm not going to go through all of these. Let's look at a couple more. So the other Steward property says that this is a passive equity ownership. This is the one down here for $139 million. Looks like Medical Properties Trust owns about 10% of that particular operator. So again, I want to go back and explain. So Medical Properties Trust owns the actual building. They own the actual hospital, but they don't own anything inside of it. All of the doctors, nurses, all the equipment, all of that stuff is owned by the operator, right? So in this case, Medical Properties Trust owns 10% of that operator, 10% of that operating business, 10% of that hospital business, and they also own the hospital, okay? And so while I'm sure they're not going into all of the details of the contract and of the investment, they are giving us a little bit of insight on how they are structuring these investments, okay? So this one says it's a passive equity ownership interest, okay, because it's less than 10% typically is what that means. The proceeds from the investment are paid directly to Steward's former private equity sponsor and other shareholders. Okay, so this means that the money that Medical Properties Trust paid to receive 10% roughly of this operator was paid to the former owners of Steward. Yeah. So you got to think about it this way. So Steward was owned by some bank, basically. Okay. So the bank owned the company. This is true of many banks. Blackstone is a prime example of that, where they will go out and just buy companies, right? And so the company stands on its own, it operates on its own, but the bank actually owns it. So in this case, a private equity firm owned Steward, okay? And so when Steward was then either sold or spun off or whatever, Medical Properties Trust wanted a piece of that particular company, right? And so Medical Properties Trust paid the old owners for roughly 10%. Okay, so this means that Medical Properties Trust gains money, right, anytime that the company Steward, does well. So when the stock price goes up, Medical Properties Trust gets paid. Maybe they have some sort of direct distribution guarantee money in there. I don't know, but the point is they're actually getting money from Steward anytime Steward does well. Okay, and they had to pay, of course, for that privilege. All right, let's look at the second one here, international joint venture. And so this is an operator in which they own 49% of. Okay, and so this says that the equity ownership interest and loan at 7.5 interest rate for the purpose of investing in select international hospital operations. Okay, so this is again equity ownership, meaning that they own 49%, and they also gave the operator a loan, right, at 7.5% interest. Okay, and the purpose of this loan is so that the operator can invest in international hospital operators. Now, from Medical Properties perspective, what they're saying is, hey, listen, we're going to give you some money. We're going to give you a loan, right? You're going to pay us interest on that loan. But what we want you to do is we want you to go out and we want you to find other hospitals. And then the idea is that with our ongoing relationship with these hospitals that we already currently have, maybe we can work a deal on any sort of new hospitals that you guys invest in, right? So that's Medical Properties Trust thinking there. And so what happens a lot of times is, and I don't know if we'll get into this, but I want to touch on it. The rumors around Medical Properties Trust, and the reason why the stock price is having trouble is because it appears from the outset, okay, that what Medical Properties Trust is doing is that they are purchasing these hospitals for way more than what they're actually worth, so that the operators have extra money to go about and do all the things that they need to do. In some cases, people are saying that Medical Properties Trust are selling these hospitals for way more than what they're worth. I'm sorry, buying these hospitals for way more than what they're worth because the hospitals are already in trouble. All right. And in this case, you can see that there are definitely for sure times that Medical Properties Trust is definitely giving the company more money than just purchasing the hospital. Okay, and to go back and explain, I've explained this in previous videos with Medical Properties Trust, but I'll say it again. Medical Properties Trust, a hospital is a hospital, right? They own their building, they own everything in it. You know, they're paying doctors, they're paying nurses, whatever. All right, so one day they say to themselves, man, you know what? We need some cash. How about we sell our building, we sell our real estate holdings to another company, and then that company is going to turn around and charge us rent. Okay, that's literally what's happening. So Medical Properties Trust comes in, they buy the hospital for cash usually, and then the hospital now signs a lease, right? And that lease usually says something like, you know, we promise to pay X amount of dollars every year. We expect the rent is going to go up by roughly 2%. If inflation increases, then of course we expect the rent is going to go up a little more because of inflation. Okay, and so that's what happens here. And so when Medical Properties Trust purchases these hospitals, not only are they paying for the hospital, but in some cases they're also doing these other deals where they're giving them loans and all sorts of type of stuff. It is important to note, and again, I don't know if we're going to get into this, but Medical Properties Trust do sell these hospitals, and typically they sell them for profit. Does that always happen? Of course not. But for the most part, they always sell at a profit. Usually is written in the contract with the prior owner, right, with the prior hospital, that if Medical Properties Trust wants to, they can sell the property back to the original owner at either fair market value or Medical Properties Trust basis in the property. Now, not going to go very far into basis. Just understand that basis is almost always going to be less than fair market value. So if the contract says the higher of the two, then typically fair market value is going to be the higher. The only way that the fair market value can be less than basis is if there is some sort of catastrophic event in which maybe Medical Properties Trust isn't being compensated for, such as, you know, natural disaster or fire or whatever, right? That dramatically decreases the value of the property. Usually fair market value is going to be higher. We know that in real estate, right? Because remember, we're still talking about the real estate sector here. In real estate, typically, real estate prices go higher over time. That's the investment thesis. And so the idea is that they purchase the property, they rent it out, and then at some point they can sell it for a profit. So let's go over just one more of these. I want to get a good one here. See. Well, I mean, all of them are pretty much the same. Let's look at Priory or Priory. So they have a 10% ownership in the operator. So it says passive equity investment. Again, it's less than 10%. It's passive. Variable rate loan, proceeds of which were paid to the former owner. So again, this means that they paid money to the former owner. Okay, this is on top of, and this is what gets hairy, right? So they paid the former owner for the hospital, but then on top of that, they also paid an additional amount of money to own 10% of that company. Okay, I missed my place. Okay, and they also gave them a variable rate loan. Okay, and that variable rate loan means that the operator will have to pay that loan back. And of course, when interest rates go up, typically the rate on that loan is going to go up, meaning Medical Properties Trust is going to get more money when rates increase. And that's the reason why sometimes in real estate, it can be a great thing when interest rates increase because the money that you're being paid on those mortgages and on those leases and stuff rise with inflation, even though it may cost you more money to go out and get loans to make real estate purchases. All right, so I think that's it there. Medical Properties Trust did purchase some more properties in Finland, so more European properties. They did say that they expect their purchases in the future to be something of 50-50, so 50% U.S. Based hospitals and 50% outside the U.S. And so they don't expect that to change anytime soon. They did also talk about, again, this entire call was surrounding trying to dispel the rumors, dispel the myths, and trying to get people to understand how the business runs and operates. And just, the CEO was just doing damage control, seriously. And so this is one of the other things that they discussed. And this is all accounting, okay? It's all accounting, but it's very important, which is why I wanted to bring it up. So remember, they're buying the hospital and then they're leasing it back to the hospital, all right? Now, what's happening is that Medical Properties Trust is in a great position as long as hospitals are paying their rent. Now, we all understand that hospitals are a decent business. However, Medical Properties Trust is a for-profit business, meaning that they're taking risk, okay? They're taking risk. Going back to the original slide, it's very possible, and I'm sure this is the case, that when Medical Properties Trust go into these negotiations with these hospitals, of course, they're trying to get as much money as possible. I mean, it has to be a win-win situation, or there's no deal getting done, right? So the hospital is saying, listen, we're selling our hospital, right? And yeah, I understand that you want to pay less for it, but guess what? You're gonna have to pay us not only this money, but then we want something else on top of that. For instance, we want a loan, or you have to give us X amount of dollars, and we'll throw in some stock, right? And when you talk about equity, you talk about stock, it's like tissue paper a lot of times, right? We can talk about shareholder dilution and stuff another day, but the point is the stock is pretty much free. And medical property trust is having to pay money for this stock. But anyway, the point is that medical property trust is in a great position as long as hospitals are paying rent. Now, when you think of hospitals, you think of, necessity, it will always be needed, always going to be around. How are they not going to pay rent? Well, again, medical property trust is taking risk. And so they're not only invested in, the large, emergency room type hospitals, but they're also invested in small urgent care buildings. They're also invested in behavioral health therapy, which is a big one. In Europe, I think they have come a bit further than we have in the U.S. when it comes to behavioral health therapy. We do know that there are what was considered a long time ago when I was a kid, the crazy house, right? Those aren't necessarily guaranteed. I mean, they're needed for sure. We're definitely paying for them, but what are the risk involved with that? Well, a lot of it is government risk. If the government continues to pay for it, great, we have it. If the government decides, we don't really need them, then it's bye-bye behavioral health therapy. Insurance is a big one, right? Again, that really kind of goes back to government, honestly, but insurance pays for a lot of this stuff. And so if something were to happen, that insurance companies decided that they're just not going to pay for these items anymore, then guess what? These hospitals are going out of business, and they won't be able to they won't be able to make their rent. The other thing is what happens when a hospital in a community is there, but the community goes away. I mean, that happens, for whatever reason, industry changes, natural disasters, sometimes it's that one company that employed most of the community just closes down or gets up and walks away. So all of this stuff I'm saying because we're talking about economic risk as well, and that goes back to where we're possibly headed as far as recession. If we start to see a lot of people being laid off, right, it's very possible that we'll see again insurance payments going down, because you have to have a job, you have to have discretionary income to have insurance to pay for behavioral health therapy, right? And so if that happens, what happens to these hospitals? The other thing, like I said before, companies shutting down and communities going away. Medical Properties Trust talked a lot about labor costs because, of course, they were asked about inflation and how it's affecting them and so on and so forth. And Medical Properties Trust said that it's not affecting their hospitals much at all. They did say that labor costs were a bit higher, but they said that all of the nurses and doctors and so forth that were contracted because of Omicron only signed 6-month contracts, and those contracts are ending in the second quarter of 2022. So that means that a lot of the hospitals that did have higher labor costs, guess what? Less labor costs. But that also goes back to my original point about the economy and where we're going, right? If all the nurses are now not having these 6 months contracts, where are these nurses going? Are we talking about potentially having nurses out of work, or are we talking about nurses just working less, right? Either way, it sounds like we're going to have less income to go around. So, that's something that gets added to that whole story. The accounting that I was alluding to is about how you evaluate the hospital itself, okay? And what you're looking at on this slide is basically 2 different ways of evaluating the hospital, all right? Now, Medical Properties Trust, what you see on the left side of your screen, this is how they evaluate the hospital. And on the right side of the screen is how some others will say evaluate hospitals. And Medical Properties Trust in this call is trying to advocate for using their way of doing it versus everyone else's way of doing it. It is important to note that the way that Medical Properties Trust is evaluating these companies is legal. Okay, it's legal, and so they're not doing anything wrong. But it is important that we talk about it. So what Medical Properties Trust does is they evaluate the hospital at the hospital level. So let's talk about that real quick. So remember, Steward is the operator, right? For a bunch of hospitals. Okay, so Steward is the parent company, okay, that owns a bunch of hospitals. So the question is if you own a hospital that's being operated by Steward, right? Do you look at what Steward, the company, is doing financially, or do you look at how that one hospital that you own is operating and functioning? See my point? Because if the parent company of Steward goes bankrupt, I don't care how profitable that hospital is, that hospital is in trouble, right? I mean, you think about from the perspective of a doctor or a nurse that's working in that hospital, okay? The company that you work for is going bankrupt, right? Most doctors and most nurses will say, oh, wow, we may be out of a job. That's a problem. That's an issue, right? Now, the way Medical Properties Trust looks at this is that we don't care what the parent company is doing. We don't care about their financials. The reason why is because we have written in the contract that if the parent company has problems, then we can simply retain the hospital, right? Find another operator, get them in there, right? And continue charging them rent, charging them a lease. Now, has that happened? It has happened. What are the chances of that being an easy process? I don't think it's easy at all, especially when you're talking about these, now I'm saying risky, behavioral health therapy buildings. Now, personally, I want to think and believe that behavioral health therapy is something that we will continue to have. I want it to continue to grow. I think it is necessary, but unfortunately, over my lifetime, that has not necessarily been the case. And so I'm a bit hesitant to say, oh yeah, of course, there'll always be someone ready and willing to take over a behavioral health therapy building, and what are those? Those are drug rehabs. Those are psycho wards. I'm trying to find a better word for it, but I mean, it's for the mentally ill, and like I say, in drug rehab too. There may even be some other types of things in there, especially when you're talking about children and so on and so forth. So again, I think it's a decent place to be. It's somewhere that they have really made a lot of investment. The Medical Properties Trust is optimistic about that particular industry. I think it's risky, and there's nothing wrong with that. I mean, that's business. That's how you make money. You have to take risk, right? Because as of right now, the government and insurance pays for that stuff. So hey, let's get it. So anyway, so the way Medical Properties Trust looks at it is if the hospital is operating and they're financially well off, meaning they're making profit and they're able to make their rent payments on time, that's a financially stable company, and they're fine with that. They're good with that. And so that's what you see here called EBITDA arm. Now, typically, when you listen to the financial news and stuff like that, they'll talk about EBITDA, right? And that's just the EBITDA. That stands for earnings before interest, taxes, depreciation, amortization, okay? And the reason why that's important is because, because taxes are something that's always going to be there, right? Personally, I include taxes because I think taxes is part of management, right? If you're properly managing the company, then you want to pay as less taxes as possible. Someone running a business that just doesn't care what their tax bill is and they just pay it because it's taxes and what are you going to do about it? I think that's horrible management, but that's just me. Depreciation, amortization are not real cash expenses. Personally, I do not include these when I'm evaluating profit. So I understand that. And then what medical properties trust is they don't include rent or management fees. Okay, so let's talk about that. So medical properties trust said in this call, the reason why they don't include rent is because it's possible that the hospital will have a negative profit, meaning that they will lose money if you include rent and management fees. Okay? And so if you do that, then it shows that the company is not financially stable, but they're still making their rent. And what Medical Properties Trust said, and the CEO specifically and CFO specifically in this call said that most hospitals are not profitable. And that's what I had an issue with, okay? Because in order for the hospital to make their rent payments, they have to be profitable. And so Medical Properties Trust is saying if they're profitable before rent and management fees, then they're profitable, they're good. But if they're not profitable after paying rent and management, then I personally see a problem there, right? I see a problem there because they're not profitable after paying rent and management fees. Then there's a possibility that they may start looking at maybe not paying rent and management fees. Now, from Medical Properties Trust perspective, the way they see it is that the hospital will cut back on a lot of things before they cut back on rent and management fees because, you know, they have to pay rent, right? Like that's just the number one expense that you're probably going to take care of before you take care of anything else. And that's fine. But under the right side that you see there, the CMS cost report methodology, it just looks at straight up profit loss, right? And if the profit loss is negative, even after you pay rent and management fees, if it's negative, then it's not a good business. And that makes Medical Properties Trust not a good business because they're doing business with businesses that's not making money. So that's the issue. Where I come down on this is that I understand from Medical Properties Trust perspective, you know, when evaluating that, like, hey, as long as you can pay us, we don't care. But I think it becomes an issue when you have a hospital that's constantly running in the negative. It is true that a lot of hospitals are nonprofit. It is true that even most private hospitals do receive some sort of federal or state funding to help keep the doors open. While that is true, you know, we can talk about Medicaid and Medicare and all these things that goes into you know, paying a hospital, right? But the thing is though, when you go into the risky side of this, and that's where I come down, right? When you get into the risky side of this, then it becomes very necessary to show a profit. Again, behavioral health therapy, yes. Government is paying stuff. Yes, insurance is paying stuff. But if you're talking about a privately owned behavioral health therapy company that is only profitable because of government and insurance, I worry a little bit. And maybe that's just because I'm old school and I'm thinking about it completely differently than maybe where we're going. But as of right now, right, something like a big, you know, a big county, city hospital, those are fine. Those aren't going anywhere unless the city goes somewhere. Those aren't going anywhere. But like I said, that behavioral health stuff, I just don't know. So anyway, that's that. I've gone on too long about that. The other thing that came up in the call, which was really funny, was one of the analysts asked the CEO whether or not him and the board have discussed separating the chairman and CEO roles. And I didn't listen to the call, but I read it, okay? And even in reading it, I mean, you could tell that the CEO just snapped at him, right? He was like, listen, okay, I've been the CEO and chairman since we began, okay? Which is common, right? I mean, he started this thing. It's his baby. He's run this by himself, and he's been the CEO and chairman ever since. And he said that there has been no discussion, no talk about separating those roles at all. The reason why this comes up, though, is because typically the chairman of the board and the board of directors, they are in control of not only how much the CEO gets paid, but they're also in control of firing the CEO. And so if the CEO is CEO and chairman, chances are that CEO is not getting fired. Chances are the CEO has a lot of say-so about his compensation, right? Because it's really hard to make a decision about a CEO when the CEO is sitting in your face and he's chairman of the board, which means that even though, he does have to deal with the other board members, he's the chairman. So his vote counts a little bit more. What you're looking at in this slide is what I think is really funny is the average support of executive compensation plan over the last 5 years. Now, the reason why this is hilarious is because remember, he's chairman and CEO. So 95% approved of the CEO's compensation over the last 5 years. What you see here highlighted is the CEO compensation, okay, non-cash. Now, this means that this is the CEO's stock compensation. So he gets paid a regular paycheck like everyone else, but he also gets paid in stock, okay? And so his stock was 76% of his compensation. And so while that is a good thing, it can very easily turn into a bad thing, and we'll talk about why that is here in a second. Currently, the CEO owns what, $77 million, or the 700 million? I'm going to go with 77 million. I'm just going to go with 77 million right now. Which and what they did was they compared all of the other companies here for the CEOs, right? And as you can see, this CEO owns way more stock than any of the other CEOs on the list. And so, like I said, that's typically a good thing because you want the CEO to have a vested interest in making sure that the stock does really well, right? And you do that by compensating the CEO in stock. Now, why that's not necessarily a great thing is because during the call, they asked the CEO, hey, are you guys still going out and doing deals? Are you buying more properties? And so the CEO said, well, we just finished, acquiring properties in Finland. So that's really cool. He says, but going forward, though, we don't plan on buying anything else unless we can do it with the cash we already have. And the reason why we're doing that is because our stock price is way down right now. Because in a lot of cases, what you can do is you can sell stock in order to get cash to go out and buy properties. But the CEO says that he does not like where the stock price is, and he will not purchase any more properties if he has to sell stock until the stock price gets back up to where he thinks it needs to be. And the thing is that while that sounds like a fairly prudent approach, it's possible that there may be some feelings mixed in there, right? Because remember, most of his compensation comes from stock. So if the stock price takes a big fall like it did, dude just missed a lot of money, right? And so he may be in his feelings a little bit. And so to say something like, I don't like where the stock is, and so because of that, we're not buying any new properties until the stock price comes up, it's like, okay, that's fine. I get it. But I I just worry that maybe you feel that way, not necessarily because of a numbers thing, but because you feel some type of way that your pockets are hurt. You know what I mean? So um, they do have a little bit of cash, but not enough to do any big deals. The CEO said that a lot of the deals right now are in the $4 to $5 billion range, and the company only has like $1 to $3 billion. And so, I mean, analysts asked them straight up. It's like, are there deals out there? Are there profitable deals out there? And the CEO said, yeah, there's profitable deals out there. There's money to be made, but those deals are in the $4 to $5 billion range, and we just ain't doing them. We got $1 to $3 billion in cash, and that's all we working with. He said that, maybe we go out and look for loans if the rates are good, but as we know, rates are going up. So not necessarily looking at loans. And he said just not selling stock at all. Not going to happen. And so again, that just goes back to the fact that as a CEO, you can make that decision, right? But then you have a board of directors that will oversee that and can veto that decision. But if the CEO is also chairman, it makes it really difficult to do that. So anyway, I had a lot of fun going through this one. I think there was a lot in this call to unpack, even though they didn't talk about performance at all. Like the entire call was just trying to do damage control and explain themselves. But it was good though, and I enjoyed it. And then, like I said, I'll be doing that valuation right now, actually.